Welcome to the Financial Matters Bullet Points. Managing Cash Crunch in a Medium-Sized Manufacturing Setup. This is an AI-assisted script-based video transformation. Understanding cash crunch, foundation and recognition. What constitutes a cash crunch? Insufficient liquidity. Not having enough cash on hand to meet immediate operational obligations, despite having profitable operations or valuable assets. Timing misalignment. Money owed to the business doesn't arrive when bills need to be paid to suppliers, employees, or creditors. Working capital deficit. Current liabilities exceed current assets, creating a squeeze even during profitable periods. Growth-induced strain. Rapid expansion requiring inventory purchases and capital investment before revenue catches up. Warning signs to monitor. Increasing days sales outstanding, DSO, taking longer to collect from customers. Growing inventory pile up, raw materials or finished goods sitting without movement. Delayed vendor payments, having to request extended payment terms or facing supplier pressure. Declining cash reserves, bank balance consistently falling month over month. Rising accounts payable, mounting bills that keep piling up. Difficulty meeting payroll dates, needing to juggle payment schedules for salaries. Immediate actions. Short-term cash recovery, 0 to 30 days. Aggressive collections strategy. Accelerate receivables. Contact all customers with outstanding invoices and offer 2 to 3% early payment discounts for payment within 7 days. Implement daily follow-up. Assign a dedicated person to call customers daily about pending payments. Many delays happen due to processing neglect rather than inability to pay. Review credit policy. Identify customers who consistently make late payments and reduce their credit limits or shift them to cash on delivery, COD. Offer settlement schemes. For customers with very old dues, offer a one-time settlement at 80 to 90% of the invoice value with immediate payment. Immediate actions. Short-term cash recovery, 0 to 30 days. Inventory optimization. Conduct a physical audit, identify slow-moving, dead stock, or obsolete inventory that can be liquidated quickly. Emergency sales push. Offer 15 to 20% discounts on overstocked items to clear warehouse space and generate quick cash. Halt new purchases. Stop ordering new raw materials except for committed customer orders with advance payments. Negotiate extended terms. Request 60 to 90-day payment terms from key suppliers. Offer to formalize this in writing. Consign inventory. For slow-moving items, negotiate consignment arrangements where you only pay when goods are sold. Immediate actions. Short-term cash recovery, 0 to 30 days. Working capital preservation. Freeze discretionary spending, cancel subscriptions, defer non-essential maintenance, postpone training programs. Delay capital expenditures. Push back any equipment purchases or facility upgrades that aren't critical. Reduce operational scope. Consider operating fewer production lines or temporarily reducing shift hours. Renegotiate energy contracts. Contact utility providers to explore lower rates or flexible payment schedules. Medium-term solutions. 30 to 90-day strategies. Revenue acceleration. Customer advance payments. Request 30 to 50% advance deposits for all new orders, making this a policy for new clients. Prepayment discounts. Offer significant discounts, 5 to 10%, for customers willing to prepay for upcoming orders. Rush order premiums. Charge a 15 to 25% premium for expedited delivery, creating an incentive for full upfront payment. Seasonal planning. If your industry has seasonal demand, front-load sales during peak seasons to build cash reserves. Target high-margin orders. Prioritize production and sales of products with better profit margins. Medium-term solutions. 30 to 90-day strategies. Cost structure review. Outsource non-core functions. Consider outsourcing logistics, quality control, or maintenance instead of maintaining full-time staff. Renegotiate supplier contracts. Review all major supplier agreements. Many will offer discounts of 10 to 15% for volume commitments or loyalty. Energy audit. Implement LED lighting. Optimize production scheduling to off-peak hours, and fix equipment inefficiencies. Labor optimization. Consider temporary workforce reduction through voluntary leave without pay, shifted work schedules, or voluntary retirement schemes. Waste reduction. Implement lean manufacturing principles to reduce material waste and rework costs. Medium-term solutions. 30 to 90-day strategies. Short-term financing options. Bank overdraft facility. If you have good credit history, negotiate an overdraft limit, typically 3 to 6 months of average payroll, at lower rates than personal loans. Working capital loans. Approach banks for short-term working capital loans. Many have simplified processes for manufacturing units. Trade credit optimization. Negotiate better payment terms. Increase from 30 days to 45 to 60 days with key suppliers. Supply chain financing. For large orders, explore arrangements where the bank finances supplier payments on your behalf. Director, shareholder advances. If applicable, take temporary loans from business owners at favorable terms. Operational restructuring. 60 to 180-day framework, production planning and scheduling. Demand forecasting. Implement proper demand forecasting to produce only what's needed, reducing inventory financing costs. Just-in-time inventory. Move toward ordering materials closer to production dates rather than stockpiling. Batch optimization. Consolidate production runs to reduce setup times and improve machine utilization. Capacity utilization. Aim for 70 to 80% capacity utilization. Pushing beyond this increases waste and reduces cash generation. Quality control strengthening. Poor quality means scrap, rework, and customer returns. All cash killers. Invest in preventing defects. Operational restructuring. 60 to 180-day framework. Customer relationship management. Segment customers by profitability. Identify which customers are truly profitable after accounting for collection costs, quality issues, and returns. Fire unprofitable customers. Discontinue business with customers that demand excessive discounts or have poor payment history. Exclusive partnerships. Develop deeper relationships with a smaller number of stable, profitable customers rather than spreading thin. Price optimization. Review pricing strategy. Often small increases, 5 to 10%, don't impact volume but significantly improve cash flow. Payment term standardization. Create clear payment terms, 50% advance, 50% on delivery for all new customers. Operational restructuring. 60 to 180-day framework. Internal process improvements. Standardize processes. Document standard operating procedures to reduce errors, rework, and associated cash losses. Regular cash flow forecasting. Create weekly cash flow projections for 13 weeks, quarterly rolling forecast, to anticipate shortfalls. Implement controls. Require approval authorization for all purchases above certain thresholds to prevent unauthorized spending. Segregation of duties, separate cash handling, authorization, and reconciliation to prevent misuse. Monthly financial reviews. Review profit and loss account and cash flow statements with the management team every month to identify variances. Long-term sustainability. Strategic adjustments. Business model evolution. Value-added services. Move beyond pure manufacturing toward providing installation, maintenance, or consulting services at higher margins. Product diversification. Reduce dependency on slow-moving products. Develop a portfolio of high-demand, high-margin items. Geographic expansion. Explore new markets or regions where demand is higher and payment discipline is better. Contract manufacturing. Offer contract manufacturing services to larger companies for steady, predictable revenue. Backward integration. Consider manufacturing key components in-house instead of buying from suppliers to improve margins. Technology and automation investment. ERP implementation. Invest in enterprise resource planning systems to track inventory, orders, and cash more accurately. Automated billing. Implement automated invoicing and payment reminders to accelerate collections. Production monitoring. Use systems to track machine downtime, production efficiency, and bottlenecks. Supplier integration. Connect digitally with major suppliers for real-time order tracking and better coordination. Data analytics. Use data to identify patterns in customer payment behavior, product profitability, and cost trends. Capital structure optimization. Debt restructuring. If you have high-cost debt, refinance at lower rates or restructure payment schedules. Equity considerations. For growth stage companies, consider bringing in equity partners to strengthen balance sheet. Dividend policy. If profitable, reinvest all profits back into the business instead of taking dividends. Asset-light strategy. Lease equipment instead of buying to preserve cash. Outsource warehousing instead of owning. Communication and stakeholder management. Employee communication. Transparency. Communicate the situation honestly to senior management. Informed teams make better decisions. Morale maintenance. Assure employees that temporary measures are not permanent. Tie their performance to recovery. Incentive alignment. Offer bonuses or profit sharing tied to cash collection or cost reduction targets. Cross-functional collaboration. Create a task force with representatives from sales, operations, and finance to brainstorm solutions. Supplier and creditor management. Proactive communication. Reach out to suppliers before payment deadlines. Many prefer renegotiation to default. Provide visibility. Share your cash flow forecast with key suppliers to demonstrate you're managing the situation. Payment priority plan. Create a hierarchy. Pay employees and statutory obligations first, then critical suppliers. Negotiate payment plans. For past dues, propose structured repayment schedules over 3 to 6 months. Customer communication. Quality assurance. Communicate that temporary cost measures won't compromise product quality. Delivery consistency. Assure customers of on-time delivery despite the cash crunch. Transparent updates. If delays occur, communicate early and provide revised timelines. Relationship strengthening. Use the period to strengthen relationships through exceptional service. Cash flow metrics. Cash conversion cycle. Monitor how quickly cash invested in inventory and receivables comes back. Target. Reduce by 15 to 20%. Days sales outstanding, DSO. Track average days to collect from customers. Target. Reduce from current level. Days inventory outstanding, DO. Monitor how long inventory sits before sale. Target. Reduce by 25 to 30%. Days payable outstanding, DPO. Track payment period to suppliers. Target. Maintain or slightly increase. Cash position. Monitor minimum cash balance daily. Establish a minimum safety threshold. Operational metrics. Gross margin. Ensure cost reduction doesn't erode profit margins below acceptable thresholds. Production efficiency. Track output per labor hour and machine utilization. Customer retention. Monitor if cost-cutting measures cause customer dissatisfaction or defection. Debt to equity ratio. Ensure short-term borrowing doesn't become a structural problem. Current ratio. Maintain healthy current assets to current liabilities ratio. Target. 1.5 or higher. Review cadence. Daily, monitor cash balance and principal payment due dates. Weekly, review collections, production status, and supplier payments. Monthly, full P&L review, cash flow analysis, and management meetings. Quarterly, strategic review of progress and adjustment of long-term plans. Key takeaway. Managing a cash crunch in manufacturing requires immediate action, combined with systematic and long-term improvements. The key is balancing urgent measures, such as accelerating collections and cutting non-essential spending, with structural improvements, enhancing working capital management, optimizing production, and strengthening customer relationships. Success depends on disciplined execution, transparent communication with all stakeholders, and consistent monitoring of cash flow metrics. I appreciate you taking the time to watch this video. We are keeping them short and to the point. We invite you to subscribe to our channel for insightful bullet points videos to stand out and shine. Please subscribe to the channel, share the video, like, and follow. It's a subtle gift to your organization's team members. Please look for Basheer Juma on YouTube and Facebook.